As we mentioned, Greece, though, under pressure to meet the terms required by the European Union to qualify for a second bailout. But is Europe's crisis alone responsible for slow economic growth? Let's talk about growth with Chris Rupkey. He is the chief financial economist at Bank of Tokyo-Mitsubishi. Chris, good to have you here. You know, we do kind of tend to blame Greece for a lot of what ails us. Is that right?
Well, it's been in the headlines a long time. Certainly. I remember, I think it's been almost 3 years now,
yeah,
right?
Long time.
It's one of those factors that can hurt psychology, and if something goes wrong there, if they can't get this agreement nailed down, I think everyone's very afraid of, it shouldn't happen again, but they're afraid of like a Lehman-type moment where the payment system kind of breaks down for some unknown reason if they try and exit. We don't really know what would happen.
But it's been going on, as you mentioned, several years and counting. We should have discounted
it in a way, but I think the payment systems situation worries me a little bit, and the interconnectedness of things and how much exposure people have, backdoor exposure people might have. What
is the drag of Europe and Greece on the U.S. economy at this point? There are, European exposure certainly by U.S. companies.
It was bigger last year when the Dow was down 19% from the highs of the year last summer. That's the biggest drag.
Right.
Is it affecting the U.S. stock market, which would affect business and consumer confidence? Otherwise, it's really just our exports to Europe, which I believe are something like 18%. I haven't looked at it for a while. It's not really moving down very much. I mean, if something went wrong in Europe, if the mild recession call got deeper, that would hurt our exports certainly to Europe and slow our growth here. But it's not happening right now at all. So.
You know, I read your notes. I mean, you tend to be one of the optimists out there about the economy. Where do you get that optimism from? Is it from the recent jobs report? What is it that kind of gives you...
The jobs report was a real shot in the arm, yeah.
It was a shock.
Yeah, I think people just get too pessimistic sometimes. There's certain ideas that grab hold of us that I don't really buy into. When growth was revised down last July, in the first half of the year to the 1% stall speed, remember there was research coming out saying, when the economy hits the 1% stall speed, bad things can happen. We can go into a recession.
Right.
And that idea really gained a lot of power. And it still does. At the moment, people have very modest growth forecasts of only 2% this year, even after the stronger jobs numbers. So
yeah, but that jobs report is an interesting one. We know the unemployment rate came down a bunch, but the participation rate, I mean, you also get a bunch of data out of that. On the participation rate, that's not optimistic at all. I mean, you've got fewer Americans looking for work. You've got Americans who want full-time jobs. They're in part-time jobs. That's not a rosy statistic.
I heard today that people are dropping out because they can get disability. They don't need unemployment insurance. They can get disability, so they're saying they're out. Look, I think the number of people dropping out of the labor force doesn't look extreme here. And I took a look at it. It was very extreme during 2009.
The share of working people in the labor force are at the lowest level in 29 years. That's not extreme in your view?
But my view is that if you think it's bad now, it's going to get worse. The first baby boomer turned 65. The participation rate of people 65 and older in the economy is not great. There's not a lot of employment for them. So I think you're going to see people dropping out of the labor force. Anyway, payroll jobs went up enough to show you this is a real strength number. So it's not secretly weak.
You're not worried at all about the recovery?
I'm never worried.
You're never worried? No, come on.
No, we're on a pretty good track here. I think it looks good. I would never worry about it. The only thing, a double dip would worry me, like if people start losing their jobs. Just the opposite is happening right now.
The trend lines certainly say differently at this point. All right, we talked about the economy. We talked about Europe a little bit. We're going to do that a little bit more when we come back. We will have more with Chris Rupkey. Let's bring in our think tank. Chris Rupkey, Chief Financial Economist at Bank of Tokyo-Mitsubishi. Now joining us, Peter Coy, Economics Editor at Bloomberg Businessweek, and Dan Alpert, Managing Partner at Westwood Capital. Dan, by the way, has just been named a fellow at the Century Foundation. That's a progressive, nonpartisan think tank on economic and governmental issues. Congratulations.
Thank you.
Welcome, everybody.
Thank you.
Dan, let's start with you. What are they talking about at the think tank when it comes to the situation in Greece and Europe? Does it take up a lot of their time, this situation?
Well, I think everybody's thinking about it from the standpoint of, is this an actual solution, or are we just really kicking the can down the road some more? I think that a lot of folks really are focused on the notion that Greece cannot solve its problems through internal devaluation and through austerity, that eventually they're going to have to exit the zone.
Peter, what about you? I mean, you've been following this for a long time, as well as all of us have been. I mean, how do you think this is going to play out?
Well, I think the IMF said today that Greece cannot keep up with its debts, even if they're written down by 70%. and which means there's still a gap between what the private creditors want and what is sustainable. Furthermore, so much of the Greek debt is no longer in the hands of the private creditors. So much is now in the bank's books of the European Central Bank, that if the ECB doesn't buy into it somehow, that is another reason why it'd be unsustainable. If this had been done a couple of years ago and more of the debt was in private hands, then more of a cram down could have been pushed onto the private creditors. You might actually have gotten a workable deal. Plus, the Greek GDP might not have fallen so far, but at this point, it's pretty far gone.
You know, Chris, we talked a little bit about Europe. You know, weigh in on what these guys are saying at this point.
Yeah, I mean, it's certainly a worrisome situation, but I think the primary thing, I mean, there's a problem with maybe the payment system if Greece goes under, like with Lehman. But remember, a few weeks ago, we were more worried about contagion. You know, who's next? You know, if Lehman goes, then another securities firm is on the line. So the contagion was going to be higher yields disease in Greece was going to spread to Spain and Italy. But, you know, it's interesting that despite all this turmoil about Greece, whether or not they're going to come to the final agreement, you know, Spanish and Italian yields are much, much lower. It just doesn't feel the same as if there would have been a breakdown in talks 2 months ago.
So, Dan, that's a good sign.
Well, you know, it's a good sign for now. You have to remember what's actually brought on those low yields, which is the ECB's LTRO program. And the problem with that, of course, is they're taking sovereign credit as the backing for all those loans that they're making to banks, which are three-year maximum loans. The problem going forward ultimately is will the ECB actually act as the agent sort of contagion as they plug all these various holes in the banking system. At some point, somebody's going to ask the question, what are they holding as collateral? What's the value of what the ECB has as collateral? That's going to be a big issue. Once that question gets asked, or at least once the market asks it through trading, then you could see an acceleration.
Well, why isn't the market already asking that question? Seems like a fair one at this point.
I wonder about that. I've written myself about the problem that the ECB is exposed, and in fact, the Bundesbank, the German Bundesbank, is particularly exposed because it has become a huge net creditor to the other banks in the European Central Bank, to the 17 countries. And I think that the Germans are starting to get really concerned about their national exposure to this.
I mean, you know, I heard an interesting phrase earlier this week about political balancing, and they said what's really going on right now, what we're seeing play out in the public is a lot of political balancing, because you've got Greek elections coming, you've got French elections coming, you've got German elections, so everybody is kind of afraid to really come out in front, come out and say things, but yet behind the scenes things are working out. I mean, do you get that feeling at all, Chris, that everybody understands kind of what needs to be done? They may not say it publicly because they're worried about the ramifications, especially with upcoming elections.
Well, I think, you know, they're making all these agreements with the current leadership of the countries, France and Germany. What if there's a change in power? That's the worry. I mean, France has elections coming up. The other thing is, I mean, this is all kind of trying to get the optics right. I'm always, you know, there's a downside to transparency. A central bank shouldn't really care about the assets on their books. I always hear like the poor ECB, Greek debt on their books. It's, you know, a central bank, well, the U.S. central bank can create money at the stroke of a pen. A central bank really gets into trouble by allowing inflation. It's not, we shouldn't be focused on the collateral on their books, but they're very, the ECB themselves are worried about the perceptions of the collateral on their own books.
Of course, the difference in the Eurozone and the United States is that the ECB can't just print money. That's correct. And that's really what's caused this whole issue right now. We have this unnatural situation, both with respect to the periphery as well as the core, where you have a central banking institution that cannot monetize. And they cannot actually take these things out and sterilize them, which is what a central bank would typically do. And you know, it all harkens back, obviously, to the big issue, which is there's no fiscal union. Right. And without fiscal union, you're not going to be able to do that.
Does any of this matter unless we really deal with the debt to GDP issue? I mean, if that isn't really dealt with in Greece, do we just revisit this scenario potentially, Peter, in a couple of years?
That's exactly what the IMF is warning about, because they kind of know in the back of their minds that they're the ultimate fallback position, and if it doesn't get solved now, it'll fall on them a couple of years from now, or even less than that.
Well, do you feel like the steps are being taken, that they're really making a difference in Greece?
No. We're headed for crashing into a wall. It's a big problem, and I think we just have not dealt with it.
You sounded much more optimistic when we talked in the last flex.
So kicking the can down the road. And it's not
guilty.
Why? Because growth is going to come back.
We have
Where's growth going to come back from?
People buy high-yield bonds in this country all the time. People, buy the bonds of companies in bankruptcy. Take a step forward, Greece. Get the conditions settled now, and then 4 years, 5 years from now, maybe they restructure it again. But let's not look 5 years from now.
Can we do that?
Well, there's another variable, right? And that's what goes on the Greek street, right? Ultimately, there are people who are being impacted by these actions.
I was reading a blog, and it's just pretty sad in terms of some of the situations.
And they're going to have their own elections. They're hoping that they can push the elections out maybe till September from April. That might happen, but at the end, somebody's going to go to a ballot box. Somebody's going to vote. They're caught between a rock and a hard place because they desperately want to stay in the Eurozone. And from an economist standpoint, that's probably the worst thing they can do, right?
Yeah.
But as a practical matter, there's this emotional attachment to being in the Eurozone, an intangible benefit, right? And on the other hand, you have the reality that they need to become more competitive. The primary way to become more competitive is you devalue your currency, which of course they share with 16 other countries.
All right, we're going to take a break. Chris, we're going to say goodbye to you. Thank you so much. We appreciate it. Chris Rupkey of Bank of Tokyo-Mitsubishi. Let's bring back our think tank. Still with us, Dan Alpert, managing partner at Westwood Capital, Peter Coy, economics editor at Bloomberg Businessweek, and joining our discussion, Mark Dow, portfolio manager at Pharo Management. And Mark, let's kick it off with you. You and I have talked a lot about Europe over the last couple of years. We just have a statistic. EU leaders have had 17 meetings in the last 2 years, and yet here we are. So what's next in your view?
Threatening more meetings. That's the best way to get concessions.
That's not a good thing.
No, I think they're going to keep working this thing until at least Greece is put to bed. And the good news on Greece is that they really have to sign something. They need the cash, and they'll worry about the implementation later. For now, the political parties have to put up the good fight to the Greek people to make it look like they're trying to get every ounce of concession that they can from the EU. That they put up the good fight. A lot of it, but there's some serious issues, and either way, whatever path Greece goes down is going to be painful. So we have to be clear about this. But ultimately, they need that cash. Whether or not things get worse later, they'll deal with that then. And the Europeans want to put the issue to bed once and for all. My doubt is that I doubt they're going to be able to.
Mark, you've worked in both the public-private sector. Tell me what you think is going on behind closed doors at this point.
Behind closed doors, the ECB and the EU are saying we've got LTRO. We can finally put we can really twist the Greeks and get them not only to commit to a lot, but put in mechanisms that help them implement, that we can vigil their implementation, because that's been the shortcoming in Greece all along. I still think they have an impossible task because the competitiveness can't really be fixed over the short term, and ultimately that path is going to be so painful that the Greeks won't be able to go down it more than another year or two without giving up. But nonetheless, the Europeans have this hope that more internal devaluation can get them there. Ultimately, if they don't do it, the Greeks will have to leave the euro, and this is where that's going to end up.
You think that? But you don't think that, do you?
Oh yeah,
you do.
That's what I said at the top of the show.
You did. You think that's going to happen?
Unfortunately, the Greeks have to choose between internal devaluation and external devaluation, which would be a new currency. The bad news is human nature means we're going to have both. First, they're going to try the internal devaluation. It's going to prove too painful, and then they're going to say, okay, that's it, we give up, and they're going to go through the external
Peter, what do you think is
devaluation.
going to be the implications of all of that, if that's how it plays out ultimately?
I think we're going to have a very poor country. Greece was a poor country.
This is their history, though, correct? We've been here before.
They've been in default for like half of their history, going back to the early 1800s when they finally gained independence from Turkey, and that's just so it's not anything new. And the folly was thinking that this was new. This time is different, and what you don't want to do is tie yourself, lock yourself. You being the Eurozone into it with a country like Greece, where you have this structural problem. I mean, economies work better when there's some fluidity. There's disadvantages to floating currencies, but there's some big advantages too, and we're seeing that at a time like this.
But the problem with the Greeks is that they have, in their memories, they don't remember stability and prosperity like they've seen since they've joined the euro. So that plus, if you get kicked out of the club or you're fired, it just doesn't feel good in your psyche.
Right.
So emotionally, they want to cling to this euro, even though it's not really in their best interest to do so.
And
I think now the system
is
ready. The system can handle them leaving, and they should get on with it.
Yeah, I mean, I totally agree agree with Mark. But I think we have to also acknowledge here that the peripheral economies, right, do need reforms. I mean, these are not economies that are particularly efficient. Many of them have anachronistic systems, guild systems, all sorts of things that really gum up the works. At some point, they're going to have to correct these, regardless of whether or not they exit the Eurozone, in order to become competitive with the rest of the world. It's very hard to imagine. I know Mark agrees. It's very hard to imagine a system where you've lost any ability to protect trade through conventional protectionist type of routes. You cannot devalue your currency, right? And the only thing left is self-induced depression, right? It becomes very difficult to understand how that's going to suddenly turn into reforms where everybody says, yes, let's enjoy this depression. Let's make our economies more capitalistic, less socialistic. This is the right time to do so. It just doesn't fly.
All right. A good point to just hold on right there. All right. Now